So maybe just to start off, we'll have everyone go around, introduce themselves and their firm. And I'd also like just a little bit of an anecdote about how you've gotten into blockchain digital assets, kind of what led you there. And Carlos, maybe I'll start with you just because you're at the top left of my screen. Yeah, feel free to introduce yourself. And you're on mute, by the way.
All right, so somebody unmuted me, so sorry. Well, thanks first to Matthew for the invitation. He's been a long-time supporter of the firm in many respects, not just as an investor. So I'm very pleased to be here supporting them, their webinar here. I started in this space in 2016. That's when Ethereum launched in 2015. 2016 is when there started to be a lot of activity there. And obviously that was when the ICOs started, and I thought it was a fascinating way of investing on a project where you could just send ETH with your wallet, get a token, and then that token was liquid after that. And I thought, like, wow, this would be great if you could actually apply this to other financial assets that are difficult to invest, that they're illiquid, etc. So we come up with the idea of tokenizing a venture capital firm. What we didn't know is that all these ICOs were completely illegal, and that when you want to tokenize a VC fund and basically issue a token that represents an LP interest, you're issuing a security on the blockchain, and there's a bunch of regulations, etc., and regulated entities that need to be involved. So naive of me, I thought, like, well, people trade securities all day long, right? There's like $40 trillion of securities traded every day. So there must be a way to do it more efficiently using this new cool blockchain, technology and ledger technology that allows you to do, better, let's say, representation of ownership, transfer of ownership, representing cash and securities alongside, etc. So we, successfully did one of the first tokenized VC funds in 2017, and in 2018 we decided to basically launch Securitize as a company focusing on the tokenization space. And then the fund started. We went through a very lengthy regulatory process of getting the necessary licenses to be able to operate. We got first registered as a transfer agent with the SEC, which is basically the entity that works with an issuer of securities in terms of issuing their securities, managing their cap table, doing compliance rules, controlling transfers and things like that, paying dividends, doing redemptions. That's the role of a transfer agent. And then in late 2020, we got a broker-dealer and ATS license and spent another year plus with the SEC getting it approved for tokenized securities or digital asset securities. And then finally in 2022, we had the whole tech platform, all the licenses end-to-end to be able to do the whole process. And that's when the kind of first breakthrough happened. We landed KKR, which is a very large traditional asset manager, as a tokenization partner. We did the first tokenization project with them. It was the first time that a tier one asset manager did anything on the tokenization space. Subsequently, we landed Hamilton Lane. Hamilton is $1 trillion asset manager. We've done 3 different tokenized funds with them. We then went through a period of, asset managers being concerned about the space because of all the illegal stuff happening and all the fraud with, FTX, Celsius, BlockFi, and all these companies. And then, finally last year, you guys might have seen Larry Fink very openly talking about, tokenization as the future of asset management and how they were really into the space. So they started working with them, and that led to the recent announcement that we've done of the first tokenized fund that BlackRock is issuing through Securitize, where we basically act as a transfer agent, tokenization platform, as well as the only distributor of the fund using our broker dealer, which I think is going to be an inflection point in the industry, given who BlackRock is and the fact that this is actually a native tokenized fund that BlackRock is issuing, as opposed to feeder funds that are tokenized and things like that. So we're very excited about it.
Thanks very much. And maybe just going down the list, Teddy, again, we just heard from Matt, but again, for those people who've just joined for this session, why don't you just give us a quick introduction on yourself, Bitwise, and how you came to the space?
Yeah, absolutely. Thank you for having me. Thank you to blockchain co-investors. Thank you, Matthew, for organizing. Happy to be here on the panel today supporting the event. Can tell from our social channels that a lot of people are excited to join in and listen to the content that you all have put together. It's been a great day of content, and we have a great panel here for this discussion. I know that our chief investment officer from Bitwise, Matt Hogan, was here just a minute ago, as you mentioned. I'm the president of the company. Bitwise is a 65-person team. We manage about $3.75 billion of assets under management. All of our funds that we offer are focused on the crypto and digital asset space. We have private funds. We have publicly traded funds that are structured and offered as exchange traded funds or ETFs. I know Matt was here talking about the ETF, the Bitcoin ETF, BITB, just a few minutes ago. We also have a crypto hedge fund, a fund of funds. And we've been running this business since 2017. As with every other bull market cycle, we have been enjoying and trying to stay afloat with all of the increased interest that we've seen thus far in 2024. A personal vignette or a bit of a story from me in terms of how I got into digital assets, how I got into crypto. My background is primarily, prior to being in this industry, has been in creating and structuring relatively novel financial products and packaging them in publicly available wrappers. So I'd spent a lot of time early in my career putting derivatives into exchange traded funds, later putting hedge fund replication strategies into exchange traded funds. And after my most recent company, which we sold to a large domestic insurance company, that was the period of time where I'd done a few early stage alternative ETF issuers, and I really became infatuated with Bitcoin, crypto, blockchain in general, and also by the idea that we would eventually be able to have a Bitcoin ETF, which we now have. That's been a 6-year journey. But it was also the thing for me that first really hooked me and pulled me in and kept me in the industry was initially Bitcoin, but it's really the idea of how Bitcoin works, which is very relevant to what we're going to talk about today with tokenization of real world assets. It was really this idea that there was this new technology that existed, this public blockchain, that would allow a user to transfer something from yourself to another person without having an intermediary involved. And when you're someone who builds financial products, when you kind of manufacture and engineer new financial products, much of the time that you spend is figuring out how to work with all of these different intermediaries. So this massive groundbreaking idea that Bitcoin represents, which is that you can have an asset that can move from one person to another without actually going through a patchwork of intermediaries, transfer agents, custodians, etc., exchanges, is really the thing that turned a light bulb on in my head, at least. And excited to chat about it a little bit today, and that's a little bit of my story.
Thanks so much. And now moving to Anthony. Yeah, obviously, I think most people here don't know Coinbase, but just humor us, give us your background a little bit on what Coinbase is doing specifically in tokenization, and then yeah, how you got into the space.
Thank you for having me. It's great to be here with good partners of ours too. Across the board, Carlos, Teddy, Mitchell, the blockchain team, we're excited to be here. A lot of people think they know Coinbase, but Coinbase is just rapidly evolving. And it happens even faster than I can keep up. So let me just take everyone through what we're doing today. So Coinbase was established in 2012, primarily as a Bitcoin exchange serving retail customers. It was largely that, with bunch of different digital assets from 2012 until about 2015 when Ethereum came out, and then eventually to 2018. So right around the time that Carlos launched Securitize, that was this pivotal moment where you started to see the institutionalization of this digital asset ecosystem, right? And so it was the time when Coinbase established Coinbase Custody. It was the time that we then expanded and built out our Prime platform to serve institutional customers across the board. So today, in 2024, we offer our retail exchange, which is the largest exchange here in the U.S. and top 2 globally. We have over 116 million customers that operate with Coinbase Wallet and trade on that exchange. We have the institutional platform called Coinbase Prime, of which pretty much everybody here is a client of as well. So thank you all. That offers custody, trading, staking, financing, lending, and infrastructure, right? So today we've got a full seamless integrated technology platform that offers all of these different solutions. Each of these components sound a lot like things that you'd get in TradFi, right? So you need a custodian, you need to be able to trade and access markets, you need financing solutions, whether you're adding leverage or if you want to go short on certain assets. You need access to multi-counterparty trading desks, right? So we offer that as agents only. We don't trade principally inside Coinbase. So it's built to be this high quality, institutional grade, qualified institution regulated by the NYDFS here in America. And we operate in 100 countries today, increasingly getting different licenses around the world so that we can continue to operate serving clients with their digital asset needs. So everything that we do today with clients is crypto specific and crypto infrastructure, the two buckets. And when we talk about Bitcoin, that's crypto. When we talk about tokenization, from Coinbase's perspective, we're talking about infrastructure. That's our role, right? So when you think about, and something we can go deeper into, how tokenized products are going to work, they operate on roughly the same rails that crypto does, right? With some nuance in there. But generally speaking, it's the same technology stack. So that's our role. We lean into this in terms of having built a lot of that infrastructure and supporting millions of clients who use us for a lot of different things to access tokenized products. My background, I joined Coinbase in 2022. My role here is I run our asset allocators business. So I'm primarily responsible for helping family offices, endowments, and some sovereigns, and even pensions around the world hold, access, and trade crypto, right? And so we give them custody and trading infrastructure. That's what I do on one side. Within that, we also help those institutional allocators access managers. So that's like capital introductions in the traditional sense on the venture and the hedge fund side. Those are one half. The other half of my time is spent helping to build out our tokenization business here at Coinbase. And so working with Carlos and others across the industry to unlock a lot of this developing market structure so that it's done within Coinbase's infrastructure and on top of multiple different blockchains where we can help people access those products. I joined from BlackRock. I was there for a decade. Prior to coming to Coinbase, I was head of pensions for iShares. And so I actually helped to sell ETFs to big institutions. Surprisingly, which is also mostly an infrastructure conversation and a unique financial wrapper conversation at that level. So I'm glad to be here and look forward to diving in.
Fantastic. Well, I mean, couldn't have asked for better introductions to this topic of tokenization. And obviously, we have a lot of perspectives here ranging from the institutional to the retail. Carlos, I think you're closest to the kind of mechanics of it. So maybe I'll put you on the spot. And for people who aren't listening, I mean, really, obviously, we have different levels of familiarity with the space. Maybe just putting you on the spot, like how would you define tokenization for someone who's never heard it? And what are the potential benefits of that? Why do we need it?
So I think Teddy explained that very well. So when you need to record ownership of an asset and you need to transfer the asset from the owner to another owner, you need a ledger, right? You need to record that, ownership somewhere. And if it changes the ownership, you need to record the change so people know who owns what, right? So if you think about how capital markets work, they're essentially two ledgers. One that keeps track of who owns, let's say, shares on Apple, and another ledger that owns, like, you have money. And then if I sell you the shares of Apple, I need to update this ledger to change the ownership of the shares, but I need to update this ledger saying you pay for the shares. And that seems like a very simple concept is actually what creates a lot of the problems of why capital markets are inefficient, why settlement periods are long, why there's counterparty risk, and that's on public markets. But on private markets, it's even more dysfunctional because there's not even like a unified infrastructure. Many times these ledgers are kept in very rudimentary ways, old technology, Excel spreadsheets, even paper certificates, believe it or not, that are still being used widely in the US, or private placements that are in vaults. And that's the problem, right? You don't have a good ledger where you can go and say, this person owns this, and that person can actually update the ownership by giving the let's say, securities, and somebody else will give them the cash. and those ledgers get updated. So if you think about what a blockchain is, at the end of the day, it's a very good ledger that was designed from the ground up to track ownership of an asset, originally Bitcoin, but later on Ethereum with smart contracts to control more things, where basically you have this ledger, is public, is cryptographically secure, so you can rely on the content. You can transfer, you can represent on the same ledger securities alongside with cash. So cash being, let's say, stable coins or tokenized cash, and securities being tokenized securities, so digital asset securities. That's where the tokenization part comes in. And then you are able to basically, issue them, track ownership, change ownership, etc., in a very, very efficient way. So tokenization essentially brings a very sophisticated digitization to, how real world assets, which most of the time they end up being securities through a securitization process or because they're funds, etc. That's most of the use cases are end up being securities. That allows you to create, a lot of efficiencies, right? So obviously there is less reconciliation problems because you can trust the ledger. That is easy to prove the ownership of an asset. That is easy to transfer the asset without an intermediary. It's easier to settle a trade instantly without counterparty risk. It's easier to borrow against it because you can prove you own it. You can put it as collateral and liquidate it if you need it, etc. So it just basically brings not just efficiencies, but also unlocks new functionality for the asset itself because it makes it digital, right? And digitization in every single industry has basically transformed that industry, creating not just efficiencies, but new use cases. So we believe that tokenization will create, efficiencies and new use cases for capital markets that today are not possible due to the lack of proper digitization of the underlying assets.
And maybe just double clicking on you for a minute there. I mean, you mentioned in your intro, you've tokenized funds for KKR, Hamilton Lane, now BlackRock. I mean, was that a concentrated strategy for Securitize? Why did you start tokenizing sort of LP stakes? Why that asset class?
As Matthew knows very well, because he spent a lot of time with me on this, tokenization, it's actually such a broad term because you can think of how much problems it solves that it's very hard to figure out what is that you're actually solving and for who. So we did not create the company thinking, oh, we're going to tokenize LP funds. That happened accidentally. We went through a very long journey of lots of different use cases and worked with different people that had different ideas about what to do. We've tokenized equity. We've done one of the most successful, Reg A+ offerings as a tokenized equity for a company called Exodus, where they raised $75 million with a security token. We've done lots of different products. And then we've come up to this conclusion more recently that first public markets, let's say Apple stock and in New York Stock Exchange or a Bitcoin ETF, that's very difficult where tokenization will be able to be used efficiently because of the regulatory situation of using central securities depositories in the US DTCC, and also because of the amount of infrastructure that has been built to deal with inefficiencies, which we'll have to displace. If you look at private markets, which is, alternative assets, funds, real estate, all type of funds, whether VC, private equity, credit, money market funds, etc., those completely lack any infrastructure, and so it's easier to then come up with some new technology to basically be able to digitize them and provide efficiency. So that's how we decided to then start focusing there. And of course the biggest lift was to convince the asset managers that that's what they should be doing. So that took a very long time until we had all the kind of regulatory framework to make them comfortable that this was legal and the licenses and everything, and I would say the credibility as a company as well. But now that we have 3 of the largest ones, I think that this is unavoidable that is going to happen across the industry.
And Teddy, I see you nodding and smiling. What do you have to add to that? I mean, what is your view on kind of the most tokenizable asset classes? How do you think the technology is being used in I guess the most efficient way for the end user?
Yeah, it's interesting, right? Because we're listening to Carlos, and Carlos has to build a business by generating revenue and unlocking use cases in the short term, right? And so he's identified the first area where traction can occur, and they're building a great business by identifying where that traction can first occur and where use cases will first occur. And I was thinking about that and how that's what Securitize is focused on, but also at the same time zooming out and thinking how big of a challenge that is for a business operator, because it sounds like that was sort of part of the beginning of the Securitize story, which is that the short answer is that it's going to happen to everything. It's going to happen to all assets. And I think the challenging part from the business building perspective is figuring out where you can generate that traction first, which is what they're working on. But when we talk about tokenizing real world assets, right, we talk about using what is now a better technology for transferring ownership than what has previously existed and what the rest of the world is currently running on, is upgrading the operating system of the financial infrastructure. And so it's going to happen over time, not just in funds, where I agree with Carlos, there's this great inefficiency that can be taken advantage of, particularly in the privately offered fund space, but also things like real estate, things like property, precious metals, art, collectibles, currencies, and eventually where even in the areas where a ton of the efficiency has already been squeezed, like in publicly traded stocks, I think eventually it's going to happen there too. I think everything that ultimately gets traded, owned, and transferred is going to experience this digital transformation. I think the old infrastructure is going to get this upgrade over time. And so that's going to be a fun thing to be a part of and to experience. And I think that we'll see where it develops first. And if you think the Boston Consulting Group had a report out early this year that said that they think by 2030 we're going to see $16 trillion of just illiquid assets be tokenized. And if you think about the size of that, I mean, there's just room for a lot of growth and a lot of assets to be tokenized.
You know, I've seen that report. It's super, super fascinating. And Anthony, I'm curious. So obviously you sit on kind of the other side of the table, Carlos. You have the access to, I mean, I want to say 95 million registered users or something on Coinbase. I mean, one of the biggest banks of deposits probably in the whole ecosystem. I'm curious, what are your clients, and you're talking to family offices, you know, every day, what kind of tokenized products do you think they're most hungry for on the buyer side? Not the issuer side, but, you know, in terms of actually, I want to, you know, have a tokenized, you know, whatever it is, yielding stablecoin, real estate, art, wine, equities. You know, how is Coinbase thinking about that for, you know, basically bringing the product to its actual clients?
So it's a great question. And I think we're actually, the entire industry is wrestling with that question, right? And it kind of speaks to why are certain products showing up first? Are they gaining traction? Are market participants using them? Is there demand, right? And I think you have to kind of step back and you have to, you know, I put my hat on and I think about my larger asset allocators who have no problem at all really managing their public book of equities, fixed income, and other types of exposures. And what they've done over the years is continue to allocate more and more into privates, as we've largely been in a zero rate world, and then everything shifted. And they're all overexposed in privates and they have no liquidity. And if they want to sell in the secondary markets, they're going to take 20+% markdowns on those assets. That's a big problem, right? It's a big problem for our pensions. It's a big problem for endowments, right? Who need some level of liquidity and also need to be able to rebalance. So when we think about tokenization, you know, I kind of start there because that's where I've spent most of my career, is like helping to solve those problems, which is how can we wrap that exposure that they already want in a better piece of technology, right? And so like I go, you know, what Carlos is building is one of those tools that's going to help us do that, right? And we have a lot to solve for inefficiency in the transfer and access of private markets. And if you go back to ETFs, it was the same thing. People wanted index exposure, but they wanted to be able to trade it throughout the day, right? And then all of a sudden ETFs were born, and then they got listed over exchanges, and it took 25 years for them to reach maturity. Now they're very mature, robust products. So like allocators are looking at tokenization primarily because they expect this same product cycle to happen and help them solve asset allocation problems within their portfolios. When you go from like the bigger allocator pools to maybe like family offices who typically focus on a lot of privates and a lot of them made their money in real estate or some other industry and still maintain a lot of exposure there. And then they start to reallocate their wealth into other asset classes, again, still mostly private. They're looking at this space saying, uh, it's kind of hard for me to get access to the best deals, right? I can't get access to the best funds. They're typically oversubscribed, and then that means I've got to play in the median of the curve of managers solutions or do direct deals myself. There's a tremendous amount of operational nuance to doing private deals, right? And they're generally not staffed well for it, right? Is there an easier solution for them to hold and access this type of exposure? Again, standardizing the format through which you own different private and public exposures into a tokenized wrapper is going to bring that kind of efficiency to the portfolio construction process for family offices. And then you go into more retail or high net worth and wealth platforms. Most of those platforms have been focused only on ETFs and like 60-40 type portfolios and have been completely boxed out of alternatives altogether, right, in the alternatives part of the market, accessing venture and other private deals. So if you're in a large RIA and you've largely only had access to public market exposure, that's mostly because of a scale and infrastructure problem. It's hard to take these traditionally private market assets and then put them into a format that I can give to an advisor and scale across 1,000 accounts, right? It just doesn't work. It works with a tokenized blockchain ownership structure, right? So going down the list of like, what type of investor are you, whether you're a large institutional allocator, family office, or maybe you're in the wealth segment, they each have their kind of different reasons. That's on the buy side. And so the reasons they would be interested in a tokenized product is partially because it's an operational efficiency gain, right? In terms of their experience investing and owning an asset. There's also utility benefit. And this is the part of the market structure that has a lot of room to grow. For those who are crypto native or crypto savvy investors and like you play around on DeFi, you've been awakened to the magic of having no rules, right? And it's an amazing experience to take your digital asset and go on chain into a decentralized AMM and be able to be a part of the AMM market making process, or to borrow against your Bitcoin instantly within the click of a button, all rules based and zero having to go through like a KYC or compliance check, right? That's an amazing experience for people. And once they go through it with their assets, you naturally ask the question, you say, wow, can I bring more of my assets that are today underutilized? And can I bring them into this format and bring them into this technology so that I can unlock value, right? And so I think that's like a good like level set for the investor mindset. They're thinking about this. Is it going to save me money? Is it going to make my investing experience better? Is it going to give me access to new markets that I can't already access? And if those three things are true, you've got the recipe for a really great market to form around these things. And we think those are true. What has to happen is a lot of the market structure is just beginning to unlock that allows us to scale that access to millions and millions of users, right? And so today, Coinbase has scaled to over 100 million users, but it's all crypto, right? And what's starting to unlock and emerge is they can actually, for example, go to Securitize and they can engage in the products they have. They can go on chain and engage in different decentralized applications through their wallet, right? The infrastructure is kind of like in the 90s when we had to give everyone computers after we laid too much broadband, right? We had all this excess supply, and then we said, oh, everyone needs computers. The cost goes down dramatically. And then pretty quickly within 5 years, you have millions and millions and hundreds of millions of people that get on the internet, and you have a robust new e-commerce business that's built. So we think we're right there at that inflection point. And the demand for products, right, is going to continue to show up. And we're seeing green shoots around the world across different asset classes. A lot of that happens within like certain regulatory unlocks that happen too across different jurisdictions, which is a big topic we can spend some time on. But I'll pause there, and hopefully that gives you a good indication as to where we're seeing demand.
No, that's super, super interesting, and a lot of follow-ups, and I want to bring in some of the other people to some of the things you said. So actually first, Carlos, so Anthony talked about, obviously the benefits of efficiency and utility for tokenization. And one of the utilities I think we think about is liquidity. obviously, Securitize has tokenized a few of these funds, probably more than anyone else in the space. Just to maybe put you on the spot, how much liquidity are we actually seeing? Like, how much would you say this is proof of concept versus we're actually seeing secondary trades happening, liquidity coming in, or how much of that is more of a future story?
First, a couple of things. One is liquidity is not black and white, right? It's a continuum. You can have zero liquidity, which is what happens today with alternative assets, or you can have highly liquid assets, like let's say public stocks or the ETFs. And then there's a whole spectrum in between, right? So I think that whatever liquidity we can bring to some assets that are completely 100% illiquid is progress, right? So that's one thing. And the second thing is that liquidity is not necessarily trading. Trading is one aspect of liquidity, but there is like how you do redemptions in a more efficient way, or how do you borrow against it, etc. So there's different mechanisms for liquidity. It could be just trading with an order book. It could also be monthly auctions, etc. So I think that yes, when it comes to like secondary market trading, like a pure trading, like we tend to think about Apple shares trading on an exchange, I think that is limited today, but it's also limited because of, first, there's a limited amount of assets that can actually trade that way, and second, because those assets are probably never going to be very liquid with that trading mechanism. So we've had some assets like a Reggae Plus offering that had 6,700 investors. That was a lot more liquid than, let's say, if you put a private equity fund, that has only 100 US investors and some non-US because of regulatory restrictions, right? So I think that's the situation today. We're seeing more success, if you want, with other products that we can make them much more liquid, or at least enable the liquidity much more efficient. We have done, like, for instance, enhanced redemptions for a credit fund using tokenization. We're now working on lending against tokenized assets, which lending against private assets is typically very difficult in actual capital markets, which tokenization solves for it. So I think that overall, I think that we're in the early days of liquidity. Also keep in mind that when people buy an asset, they want liquidity, but they don't want liquidity tomorrow most of the time, right? Like if you buy a private equity asset, you don't want to wait 10 years, but you also want to sell it the year after you purchase it, because the year after you purchase it, you're probably going to sell it for less money than you bought it, right? Because those assets have a J curve, so they go down before they go up. So I think that because we're in the early days of tokenization, many of those assets are not yet ready for entering the liquidity window where, an asset is 2 to 5 years old, has returned enough money to the investor, and is appealing for an investor that wants to reduce the risk by not buying at the beginning and buying it later. So I think liquidity, in my view, as a company, because we do transfer agency, we do broker-dealer for primary and then secondary, I think that this is kind of a building steps, right? First, we need to, tokenize as many assets as possible, then place into as many investors as possible, and then enable liquidity, which is going to take longer naturally to happen.
No, that's a great point. It is obviously a stepwise improvement on something being completely illiquid. And maybe just sticking with you, something just came into my mind, and again, just to kind of double click on something. So you obviously tokenize all these funds, and I'm curious how you think and how your clients think about which blockchains they want to be on top of, and specifically the kind of distribution between permissionless blockchains. Let's say Ethereum. I know the BlackRock fund that you've tokenized is on Ethereum, or maybe permissioned or whitelisted blockchains, or some combination of the two. So yeah, Carlos, how are you thinking about that? What are your clients wanting? Are they fully bought into the fully permissionless Ethereum vision, or is there some spectrum that they sit on?
I will speak of my own opinion rather than speak on behalf of my customers, but I can tell you, like, if somebody asks me what should I do, my answer will be do it on a public blockchain, because there's a public blockchain and permissionless, meaning that anybody can participate, is where innovation happens, right? Because tokenization is also about compositability. How do I issue this token that represents a security, but then I have a stable coin that is tokenized on the same blockchain by somebody else, and they can interact because they are on the same ledger with the same representation, and somebody else is going to come up with, some lending protocol, and somebody else is going to, enable some sort of trading where they can take the token and trade it there, etc. And those things will not happen easily on a permission setting, because by definition it's a closed ecosystem where only approved participants can participate. So innovation is always going to be very, very limited in permission environments as opposed to in permissionless environments. And I think the internet is a good example of that, right? Like the internet had American Online and MSN, and those were closed ecosystems, which were good to test the waters to understand how internet worked. But the innovation happened when the public internet, which was open for anybody to participate with open protocols that people could interact with, etc. That's where the innovation really happened, and why today we're doing, you know, a Zoom webinar on the public internet, and you don't need the closed networks of the telcos anymore. So I definitely think that public blockchains is where the future is. Now, that said, it also depends on who you are, because today regulators, in particular the OCC, which regulates banks, recommends them not to use public blockchains. And therefore banks, you see that a lot of the tokenization, not really, I think, real projects, but at least the pilots or the first things that the banks are doing are all happening on their own private networks. But it's not by, you know, knowing some of the people working on those banks. It's not because they think that's the future. It's because they can't do anything else, because the regulator doesn't allow them to use a public blockchain. Now, asset managers or broker dealers like us or transfer agents, we're not subject to OCC regulations. We're subject to SEC regulations. So far, the SEC has not issued any statement prohibiting us to use public blockchains. They've issued a number of different, you know, no action letters and other things telling you that, because that's financial service infrastructure at the end of the day, where you keep record of things, you need to have some mechanisms to prevent from problems, whether it's a fork or a 51% attack or somebody losing their private keys and stuff like that, which we do. But that allows us to basically issue on the public blockchain, and all our funds are all issued on public blockchains. And we've worked with, obviously Ethereum is the largest one, the first one we worked, but we've worked with other ones that are like, you know, Polygon or Avalanche. And obviously we're looking at other projects like Base, etc., that are coming up that are growing, that those are good platforms for us to issue products. So.
Thank you for that. Very, very interesting. I guess, Teddy, I saw you nodding a lot. Maybe I'll just give you a second to comment on that question before I actually have some specific questions about Bitwise. But yeah, how does Bitwise view the public v private blockchain dilemma?
Yeah, I was going to comment not on that, but on two other things that were said that resonated with me. I mean, Carlos said earlier, efficiency and then new functionality, right? And then Anthony had said also, we're on the cusp of seeing all of these things bloom. And he talked a little bit about what crypto users can do in the DeFi space now with their tokens. They can go to a website that is running a decentralized protocol, and they can swap, or they can lend, or they can borrow, use these tokens as collateral. And I think that's a kind of important thing for people to realize about where we are in the cycle. This is very much the onboarding phase, right? Every new fund, every new tokenized asset that Securitize helps an issuer bring to market, or that Coinbase onboards to help figure out how to approach this space, is really building the foundation of what will be the benchmark, the baseline for the next phase of growth. And it's kind of hard at first, right? It can be rough sledding, it can be slow going, because I hear questions like this. Well, is there, how much liquidity is there? It hasn't traded, or like, this thing is a 10-year lockup fund. Do you really need to tokenize it? And I think you need to kind of understand and think about those two things that both Anthony and Carlos had said, which is, this is happening in phases. The first phase is the onboarding. The efficiencies are going to come. We see these things happening in the other markets where, as Anthony said, look, it's DeFi. You go on, you have a web connection, you have a wallet that you can connect to a DeFi application. You're able to just do it on your own. Institutions can't do that, right? It's not going to work for them. But it's the tokenization of these assets that makes those things possible in the future. And I think that's an important thing for people who are here listening to think about, is not like, okay, we've onboarded a new tokenized fund, or we see that this new tokenized fund is issued. What happens tomorrow? It's, okay, what is going to happen in a year, in 2 years, in 5 years, in 10 years? And I think that's when the opportunity set really begins to expand. And you can really think about how exciting it is, what is going to happen over the long term in this space.
Look, this debate about efficiency versus new functionality, I think that all innovations that have become big have never been about efficiency only. Never. So it's always been about creating new markets or doing new stuff that you couldn't do before. So yes, tokenization has efficiencies. There's no question about it. Eliminate intermediaries, reduce cost of serving, stuff like that. But this is going to explode when you really do things that you couldn't do with the analog asset, because
Right.
that really unlocks the value and new people adopt it, etc. So it's not about, the iPhone didn't take off because it was smaller than the PCs, because then you could carry a pocket and a computer in your hand and do the stuff you couldn't do with previous phones and things like that, right? So the efficiency of the size was not what took off, but the functionality that it had. So I'm a firm believer that just approaching this from an efficiency perspective, like some asset managers are doing, where they tokenize something where you can do anything with the token. I think that's completely not a long-term solution of anything.
So maybe asking you guys, both of you or all three of you, to put on your futurist hat, like maybe speculate, or what do you think some of those new use cases would be? I mean, are we talking about using new forms of collateral that we previously couldn't use, earning yield on assets we couldn't earn yield on before? And maybe just like double clicking on your point, Carlos, about kind of new ideas coming out of it. I'll ask you to speculate what you think some of those could be.
I think from the discussion we're having with people, the first is that make the asset more accessible. That's kind of new functionality, if you want, because you allow more people to participate on the underlying asset. Today, private markets and alternative assets are very much the realm of the institutional investors and the really ultra high net worth individuals. So people that have accounts with wirehouses. It's all a manual process. It's very inconvenient. It's very inaccessible. You need to have a lot of money to be able to participate. So you're kind of missing on touching those asset class, as opposed to, let's say, public stocks or ETFs where anybody can buy them. So I think that's the first unlock of value, if you want. The second one is how easy you can then trade it or liquidate it or redeem it or borrow against, etc., which unlocks the value of the of the liquidity, if you want, in different forms of shapes for the asset. And I think the third one then is all the kind of crypto innovations, where these assets, which of course have some barriers of integration because crypto is completely unregulated and this is regulated, so sometimes those things don't marry very well. But if you think about how some of this crypto innovation, like lending, DeFi lending, or automated market making, can eventually work in a regulated world and provide those functionalities to these assets, I think those are kind of like the next generation of functionality, that a new value that we'll see coming from tokenization.
Yeah, that makes a lot of sense. Oh, go ahead. Sorry, Teddy.
Oh, I was going to say, yeah, all of those things make sense to me, but I would also, and so I completely agree with those. I think those are interesting, fascinating, likely to happen, and things that will be big unlocks for the space. But I also just remind the group that when the internet became a thing, we didn't know that one of the major use cases would be that we didn't go to the grocery store anymore. We ordered delivery from Uber Eats and from Instacart or whatever the use cases were going to be. Can be very hard to predict exactly what flowers are going to bloom. I think a thing that is true about where we are in this tokenization cycle is that the financialization, the upgrade of the financial industry is really not that old. It wasn't until the 1970s that we got the Depository Trust and Clearing Corporation in the United States that took settlement times from trade date +6 to trade date +3. That's 50 years ago, right? There is and now in 2024, we're finally moving to T+1 settlement. And this is a big challenge for the industry. And that's with the most liquid, most efficient parts of the market, which I said earlier, I think probably the last pieces of the infrastructure that are going to modernize and become tokenized and run on blockchain rails. So I think just also for the listeners to kind of remember that this is a big revolution, and that these new avenues of liquidity, of use as collateral, of tradability, of speed and efficiency of moving the assets that you own that previously you couldn't use in that way at all. It's just there are many different things that are likely to evolve from this becoming a reality. I mean, our stock market still closes at 4 p.m. Eastern time every Friday for 2 days. Like Coinbase's crypto exchange never closes. The DeFi market never closes. What does that mean? What are the implications of that? I think there's really a lot to think about.
It's very interesting because there's kind of people on the TradFi space, like the new entrants there, like Robinhood, are trying to, improve that with existing infrastructure. Like Robinhood today allows you for 24 trading, allows you for fractional ownership and stuff like that, which was not possible before for no reason, because there's no rule actually that says that you can't trade after 5 p.m. That doesn't exist. It's a convention of the industry. And then there's the other side of the coin of saying, okay, forget about fixing that infrastructure. Let's create a new infrastructure that will allow for those things to be done from the beginning under this new infrastructure, which is what we're all trying to do here with tokenization and public blockchains, etc. So,
we couldn't agree more. And Anthony, you seem to have had a comment as well. So go ahead.
I'll give a couple examples just to help people get a little bit concrete. A tokenized money market fund allows an institutional investor who holds that in their wallet to post it as collateral to one or multiple parties. So if I want to trade on different exchanges, right, and I hold this asset, I can post that asset as collateral, and then I can move it from one to another and trade somewhere else. You can't do that in TradFi, right? I've got to sell my money market fund, go to cash, move my cash across bank A to bank B, and then rebuy their money market fund, and then they might approve me for some kind of margin loan or something. Really simple use case, right? There's $6.5 trillion sitting in money funds that's being underutilized, right? So that's one. Another, if I want to issue debt, right, I have to go through a multi-month process with a investment bank who's authorized to issue to raise capital for me in a particular jurisdiction. Most of that time is paperwork and filing, right? And then you have multiple intermediaries that are part of that process. You can bring that process down to the actual issuance is a few clicks of a button now, but the book building time still takes time. So go from a few months to a few weeks, maybe a few days. So like debt issuance is going to rapidly evolve. Jurisdictions like Switzerland, you can already do it pretty quickly, and there's others emerging around the world. If I want to, people ask about tokenized real estate a lot. Am I frozen there? People ask about tokenized real estate a lot. So, there's one version of this where you're taking an asset and you're putting it into an LLC or an SPV or an SPC or something, and you're tokenizing that structure into a vehicle on chain, and like that's like the fund tokenization version. Others are, there's a company that is they're a title company that helps you tokenize your deed, right? So if I have tokenized real estate over here, but I don't have the deed process digitized, it's like, cool, I can transfer, maybe I can sell a piece of real estate on the blockchain between two parties, but you still have to go to the county courthouse and fill out paperwork, right? So this company is digitizing the deed updating process, and we have the digital real estate. With those two together, you can now have a full end-to-end transfer process for an on-chain experience. And so like this is a really big unlock for real estate. It allows us to finally I don't know if there's any real estate agents in the room, but maybe we'll get rid of that 6% commission that sits in the middle. And again, that's one of those big things of inefficiency in the system that's been there for a long time, when everyone scratches their head because we all go find our own house and we find our own buyer, and then we have to go to a real estate agent, pay away 6% commission for them to do the paperwork. We're trying to get rid of those things. That's what this system update does. We're starting to see things like tokenized insurance and reinsurance, traditional types of weather insurance, cat risk, traditional ILS, industry loss warranty bonds, right? These are typically very institutional type products that live on one end of the risk spectrum because they pay out when there's a big event, right? But generally you can just clip coupons for a long time. That asset class is totally off. It's inaccessible for anyone except for big pensions, right? We're tokenizing those products, and we're bringing those on chain, and then they are now accessible because you can fractionalize the structure of ownership there. So it allows people to augment the way that they invest in their portfolios. And so like I can go kind of on and on and on in terms of the different types of use cases and like what people should expect. You asked about watches and art earlier. That one gets a lot of consumer buzz, but it's real. Like, so if I have a Rolex that has a custodian who gives me some kind of actual mark on it, or if I have some really expensive whistle pig, and somebody comes in and says this is worth 100 grand, right? I can ship it to a custodian, and then there's multiple. It's called startups, but they can tokenize my asset, and now it's worth 100 grand, and I can go and collateralize it, and somebody can lend me money against my whiskey, right, on a blockchain. And so I'm unlocking value for something they're probably never going to drink, right? And if I default on it, the custodian ships it to the person who lent me money. So I think you just like everyone has to kind of expand their imagination a little bit and go, all right, what if I could digitize the value of this thing? What could I do with it, right? Hopefully somebody builds something for me. A lot of times when people are saying, I wish someone would build this, that's happening in crypto today.
And we're really talking about like the financialization of spreading to many different products and markets that it previously couldn't touch. But a fantastic answer. So we've had some really interesting questions. We've been here a long time, so I think we're just going to do a few questions and let you all run. So maybe Philip or Kim, if you could turn off the recording, we're now going to move to kind of the Chatham House rules section.